You think that one epic 500% crypto moonshot will skyrocket your trading account to freedom, but you're chasing a loser's fantasy. Ask yourself, has that one big win ever actually set you free? Real wealth explodes from stacking 1% wins daily through ironclad risk rules, not heroic gambles that wipe you out. Stick around to see why pros swear by this counterintuitive edge. I'll reveal the exact math behind it soon. Here's the harsh truth. 95% of retail Forex traders blow up their accounts, per the FXCM 2022 study, mostly chasing those big occasional wins. You risk it all on one trade, and poof, years of grinding erased in hours. Think about it. One bad bet on a sure thing, Tesla swing nukes your progress, while consistent 1%ers turn your 10K starter into 1.3 million over 20 years at 20% compounded. No hype, just math. But what if I told you this compounding crushes moonshots every time? Your edge awaits. I've been there. Chased a 10x Forex moonshot on GBP JPY in 2015. Lost 40% of my account overnight. Brutal lesson. But I've traded through 3 market crashes since, compounding 25% yearly on 1% risks per trade. No moonshots, just survival. By the end of this, you'll get why small, consistent wins crush big swings forever. Proof from Warren Buffett's steady compounding to blown-up geniuses like that Bell TCM hedge fund collapse. But why do smart traders like you fall for the big win trap? Let's break down the math that changes everything. Ask yourself, does that dopamine rush from a 50% balloon feel worth the inevitable crash? You chase those big occasional wins because they light up your brain like a slot machine jackpot. Pure dopamine rush. One massive score, and you're the hero. Your account balloons 50%, 100%, dreams of quitting your job flash by. But here's the trap. That high blinds you to the downside. You skip your 1% risk rule. You pyramid into the trade with 10x leverage. Suddenly, a 2% reversal hits, and poof, 50% drawdown. Your mental capital, shredded. Your revenge trading, tilting hard, accounts circling the drain. Sound familiar? It will end in tears unless... Picture yourself as that struggling beginner. You're up 300% on a hot meme coin like Dogecoin in 2021. Euphoria hits. You lever up 10x on the next pump. Market flips. Leverage wipes your 5K starter to zero in days. Heart sinks. That's not trading. That's gambling disguised as edge. The stakes couldn't be higher. FXCM's 2022 report shows 95% of retail Forex traders lose money long term. Why? Big win chasing amps your risk of ruin to near certain. 120% blow up on a can't miss Euro USD breakout and you're back to square one, or worse in debt. Made $100 million shorting the 1929 crash. Lost it all twice by chasing volatility highs. Died broke. Genius unmet by discipline. But here's where it gets interesting. Common myths keep you hooked. You need home runs to get rich quick. Wrong. Compounding 1 to 2% daily crushes it. Only volatile geniuses thrive. Nope. They blow up spectacularly. Consistency's boring and slow. Tell that to pros turning 10K into 7 figures without fireworks. Here's what nobody tells you. Trading psychology trumps strategy every time. Discipline preserves your mental capital, letting you exploit edges when others panic. Big wins erode it, leaving you reactive and broke. I'll show you Warren Buffett's secret sauce later, the steady compounding that built his empire without a single moonshot. But first, here's the thing. It's not just theory. Let's dive into insight number 1, how compounding crushes volatility with math that'll flip your trading forever. Imagine this. You start with $10,000. Nail just 1% gains daily through disciplined setups. High probability pullbacks on the S&P 500 futures, risking 0.5% per trade. No heroics. After 250 trading days, compounding turns your account into over $12 million. That's 1,000% plus annually. Sounds insane? It's math. 1.01 to the 250 equals 12.18. Your money snowballs relentlessly. Remember that loser's fantasy from the start? This is the reality. Now chase big wins. You hunt 5% moonshots at 1 to 5 risk reward. Need 20% accuracy to break even long term. Miss that, one string of losers and you're vaporized. Data backs it. A 2023 Trade Society study of 10,000 retail accounts, those grinding 60% win rates at 1-to-1 RR, averaged 25% yearly returns. Big win chasers, negative 15%. Why? Your brain craves the rush, but probability crushes you. But what kills you fastest? Wait for it. Here's the rule of 3 for small wins. Survival first. Never blow up your account. Growth second. Steady edges stack. Scale third. Position size up as equity swells. Big swings, they flip this. You survive maybe 30% of the time. Growth stalls in drawdowns. Scaling, forget it after a wipeout. Think about the turtle traders. 1983. Richard Dennis bets he can train novices. Picks 14 rookies off a newspaper ad. Teaches trend following with ironclad 1 to 2% risk rules on commodities like coffee and crude oil. No discretion. Result, 1983 to 1984 they average 80% returns. Jerry Parker, one turtle, still runs Chesapeake Capital. 15% CAGR for decades. No fireworks. Just consistent cuts on losers, lets winners run. You could do this. Your edge doesn't need genius. It needs rules. But here's where it gets crazy. Counterintuitive truth. Volatility feels alive, exciting, like a casino high, but it erodes your edge. High variance trades spike dopamine on wins, numb you on losses, you overtrade, revenge trade. Small wins, boring, they build unbreakable habits, your psychology strengthens. Others panic sell at bottoms, you're buying. Let me tell you about Mike, a struggling beginner I coached. He chased crypto pumps, up 500% on Solana, then levered into a 40% drawdown. Quit twice. Switched to 1% targets on Forex pairs like ERUSD, 0.5% stops. 6 months, 18% return. No stress. Finally sleeping, he said. That's your transformation. But variance doesn't just slow you, it kills. Hang on tight. Variance kills. It doesn't just slow you down, it wipes you out. Picture this. You're swinging for those big occasional wins, risking 5% per trade, because, hey, your stops are tight at 20 pips. Feels smart, right? Wrong. Van Tharp's Monte Carlo simulations prove it cold. With 5% risks, on even a solid 55% win rate edge, 40% of accounts hit ruin within 5 years. 40%, gone. Your money, dust. But drop to 1% risk, those same edges survive 100-year drawdowns. Your capital lives to compound another day. Think about it. You're not losing on bad trades. You're dying on streaks. 5 losers in a row, at 5% risk, that's a 22% hit. 10, nearly half your account vaporized. You panic, double down, revenge trade. It's over before you blink. Variance kills more than losses ever could. Let me hit you with a real horror story. Long-term capital management, LTCM, the geniuses of Wall Street. Nobel winners Myron Scholes and Bob Merton. From 1994 to 1998, they printed money on bond arbitrage plays, 25-to-1 leverage chasing those safe big wins, billions in fees. Then 1998 Russian crisis hits. Correlations blow up, 4.6 billion gone in months. Bailout by the Fed to save the system. Scholes later admitted it. Smaller risks, and we'd have survived. Your hero trades, they're LTCM in slow motion. You feel invincible until the black swan pecks. Ask yourself, ready to dodge that? Here's the counter you throw at me. But I have stops. Big wins pay for the losses. Sure, until variance streaks you. Stops work in theory. In reality, DApps, slippage, emotions override. You move them. Just this once. Boom. Ruin. I've seen it in dozens of blown-up traders. One guy, Alex, your classic struggling beginner, chased NASDAQ pops in 2021, 4 to 6% risks on NVDA calls. Up 300% by summer. Then September correction. 7 losers. Account from 50K to 12K. Quit trading, blame the market. Sound familiar? That's your future without rules. Like the 95% stat we started with. Empathize with you here. Big wins light you up. Dopamine rush. Feels like mastery, but it's a trap. Your brain craves the thrill, ignores the math. High variance erodes expectancy faster than steady grinds build it. Relief comes easy though. The fix? Ironclad 1% risk max. No exceptions. Watch your equity curve smooth out. Drawdowns shrink to 10 to 15%. You sleep. You scale. Survival enables success. That's your edge. Real trader proof. Jerry Parker, turtle trader vet, stuck to 1 to 2% cuts religiously on trend breakouts. No blowups in 30 years. 15% CAGR at Chesapeake. You could mirror that. Start tomorrow. But here's where it gets interesting psychologically. Variance kills more than losses. It preys on your psychology. Think about it. Your brain loves this chaos, but here's what nobody tells you about fixing it psychologically. Stick around. Your trader DNA depends on it. Your impulses, totally normal. You're wired for the big score. Evolution's fault. Hunter-gatherers chased mammoths, not berries every day. But in trading, that thrill-seeking brain betrays you. Here's what nobody tells you. Small, consistent wins don't just build your account. They rewire your trader DNA. Think about it. Every tiny victory, nailing that 1% risk on a high-prob setup like a 50-period EMA pullback, triggers a dopamine hit. Not the fireworks of a 20% moonshot, but steady drips. Science backs it. A 2018 Neuron study used fMRI scans on 40 free traders. Micro hits strengthen the prefrontal cortex, your discipline center. Big wins, they overstimulate the nucleus accumbens, creating more chaos. You chase, you blow up. Small wins forge neural pathways like steel cables. Your decisions sharpen. Impulse control, ironclad, legend. 60% CAGR over 30 years on commodity trends. In 1987's Black Monday crash, markets tanked 22% in a day. He went up 250%. How? Ruthless 1% risk rules. No heroes, just systems. Seikoda says it plain, win by not losing. He turned raw talent into a machine through daily consistency. You think he's a genius? Nah. He built it, trade by trade. Social proof right there. Pros swear by this. Now picture Mike from earlier, your struggling beginner. Started in 2022 crypto hype. Risked 5 to 10% per swing, chasing Elon tweets on Doge, up 150% fast. Then FTX collapse. 5 straight losers. Account halved. Rage quit for 6 months. Came back my way skeptical. Small wins are for wimps, he said. Forced him into 1% max. Paper trading high prob setups daily. First month? Boring. Plus 2.3%. But streaks built. Prefrontal fired up. By quarter 3, live account. 18% gain. Max drawdown 7%. Mike's email. Feels like mastery now. No more tilt. From blown up amateur to consistent pro. That's your path. But recovery math, that's brutal. Here's the crucial part. Habits compound like capital. 1% win daily. Rule of 72 says your discipline doubles every 72 trades. Miss it for moonshots? Back to square one. This debunks the genius myth. You don't need savant IQ. Paul Tudor Jones, moonshot chaser early on, learned consistency post-1987 cotton trade. Now billionaire. Talents table stakes. Your edge, rewiring for small wins. You're feeling it now, hope bubbling. Those impulses, normal. But you can hack them. Daily 1% practice. Track it. Watch your trader DNA emerge. Discipline feels boring at first. Sleep-inducing even. But recovery math? That's brutal. Let's crunch those numbers next. Your wallet's screaming for it. Recovery's hell. Yeah, your wallet's screaming for it. Let's crunch those numbers right now, because this asymmetry, it's brutal. Here's the thing. You drop 50% on one bad bet. Think you claw back with a 50% win? Wrong. You need 100% just to break even. Starting from half, your 100K account's now 50K. Boom. Double it to 100K. Simple math. But wait. Add taxes, slippage, commissions. You're chasing 150% or more. Let that sink in. One moonshot wipeout and you're grinding for years. Pause. One crash undoes 10 winners. Feel that tension? Picture this. S&P data from 1928 to 2023. CXO Advisory crunched it. Steady 2% monthly compounding, crushes volatile spikes every time. Those big occasional wins, they flash hot then fizzle. Why? Drawdowns kill momentum. Your steady path? 10K at 2% monthly, 12 years later, over 35K. Chase 20% spikes with 50% crashes. You're lucky to hit 15K if you survive. You see it? Small consistent wins stack. Big ones, they bury you. Think about Jesse Livermore. Legend, right? 1907 panic. Millions made shorting Union Pacific at $160. By 1929, $100 million peak. Your hero? Nah. Chased bigger wins post-crash. 90% drawdown by 1934. Bankrupt. Died broke in 40. His memoir, Reminiscences of a Stock Operator, blames it straight. Oversized bets on sure things like wheat rallies. No risk caps. No daily discipline. He knew setups, read the tape like God, but psychology betrayed him. One loss snowballs. You're feeling that empathy now. The struggle's real. Livermore's tension? Yours, if you swing big. Here's what nobody tells you. Losses aren't linear. They're exponential thieves. You risk 5% per trade, string 3 losers, 15% gone. But that 50% whole, not from one trade. It's the emotional spiral. Tilt doubles sizes. Revenge trades quadruple it. Suddenly, your account's a crater. Counterintuitive insight. The pros don't avoid losses. They cap them tiny. 1% max. Why? Recovery is your superpower. From 7% drawdown, just 7.5% gain gets you even. No sweat. Your prefrontal cortex stays chill. No burnout. Let me tell you about Sarah, the blown-up trader. Forex swings in 2020. Big AUD/USD calls on COVID news at 0.55, up 80% in weeks. Then revenge, 60% drawdown. Quit trading, burned out. Came to me last year. Small wins, boring. Forced her, 0.5% risk. High prob setups only like pin bar rejections. Tracked recovery daily. First quarter, plus 9.2%. Maxed at 4%. Now, she's up 42% yearly, scaling positions. Email last week. No more nightmares. This is freedom. Hope rising? That's the insight hitting. Avoidable wipeouts build your castle. Rule of 3. Survive, compound, scale. That's your transformation. Habits wired in. Track your drawdowns weekly. Cap at 1%. Watch recovery flatten. Tension fades. Satisfaction surges. You're not gambling, you're engineering wins. And scaling, big wins cap you out. Unlike this path, Buffett's waiting. Recovery's hell after those monster swings. But scaling, that's where big wins slam into a brick wall. You can't grow them without exploding your risk. Here's the thing, chase 20% home runs and you're capped at retail size forever. Why? Liquidity dries up. You pile into a stock like GameStop on a meme frenzy, fine for $10,000. But scale to 1 million, slippage eats 5%. Regulations kick in, pattern day trader rules, wash sales, margin calls, your broker flags you. Institutions laugh, they don't play that game. Think about it. You swing for fences, win big occasionally, thrilling. But repeat, markets notice. Front run you. Volatility spikes on your entry. Your edge vanishes. Here's what nobody tells you. True scalability lives in small, consistent edges. Pros like Renaissance Technologies prove it. Their medallion fund, closed to outsiders since '99. 66% CAGR from 1988 to 2018. How? Micro edges, 0.1% per trade, thousands daily on StatArb, high frequency tiny wins, compounded to billions, not one grand slam, a blizzard of singles. You can do that too, at your scale. No regs, no slippage walls. Let me tell you about Warren Buffett, the Oracle himself. Berkshire Hathaway 1965 to 2023, 20% CAGR, beats S&P's 10% double. His 2022 drawdown, just negative 4%. S&P cratered negative 18%. Why? He doesn't chase rockets. Value picks like Coca-Cola, held forever. Small, consistent edges on massive scale. $36 billion personal fortune. No blow-ups. Empathy for your struggle. You've blown accounts chasing Tesla moons. Tension builds when size limits hit. But hope? Buffett's path is yours. 1% risks, compound quarterly. Your 50,000 becomes 500,000 in 10 years at 15% net. Scale positions as you grow. No ceilings. Counterintuitive truth. Big wins feel scalable in Sims. Reality, they shrink your edge. Small wins expand it. Position size grows with account. Rule of 3. Liquidity proof. Regulation free. Compounding machine. Sarah from earlier, she's scaling now. 2% risks on 200,000. Up 18% Q2. No nightmares. Everything connects now. Survival lets you scale. Psychology beats heroics. You felt the cap. Here's your unlock. Consistent pros engineer infinities. But the ultimate revelation? Your transformation starts here. Stick with me. One final punch will wire this forever. Consistent wins aren't just about your account. They compound your psychology too. Big occasional wins, they shatter both. Here's the aha moment you've been chasing. That 1% daily edge, boring, right? Compounds to 37 times in a year. No stress, no blow-ups. Your $100,000, 3.7 million. Flashy 100 times lotto, counterintuitive truth. It destroys you. One hit feels godlike. Misses, you're broke, tilted, quitting. Small wins build a fortress. Low variance, habits stick. Recovery's a breeze. One bad day, you're back tomorrow. Scalability, infinite. Your edge grows with your wallet. Think about the turtles. Richard Dennis's experiment, 1983. Average nobodies taught trend-following rules on 20 markets. 1-2% risks max. Consistent edges. Turned $1 million into $100 million over decades. No heroics, just rules. You can do that. Anyone can. Contrast Jesse Livermore, genius trader. 1907 panic, made $3 million, $100 million today. But big swings, crashed 3 times. Suicided, broken 40. Ed Seykota, turtle mentor. Same markets. Cut losses at 2%. Compounded 60% yearly for 12 years. Trend rules. No chasing moons. Your path, Seykota's. Close the loop on Buffett. He's your archetype. 20% CAGR. Fortress mentality. You adopt this? Hypothetical you. Blown up trader. 20K left. Swear off lotteries. 1.5% risks. High prob setups only. Year 1, plus 25%. Year 2, plus 35%. Compounding snowballs. By year 5, 250K. Quit job. Freedom. Stress-free doubles yearly. No more weekends charting revenge trades. That's your transformation. Tension peaks when you realize you've wasted years on variance traps. But hope surges. This is unstoppable. Compounding capital. Forging discipline. Everything clicks. You've got the blueprint now. Make it yours. One last piece seals it forever. My own story from the 2022 crash. Markets tanked 25%. I stuck to my 1% rule on NASDAQ futures. One trade blew. No sweat. Lost $400 on a 40K account. Kept stacking small wins. Ended the year up 28%. You need that edge. Here's the truth. Small, consistent wins crush big occasional ones. Math compounds your capital. Psychology keeps you sane. History, from turtles to Seykota, proves it. Ditch the moonshot fantasy for 1% stacks. Your path to freedom. Start today. Risk max 1% per trade. Journal every daily win. No skips. Backtest setups hitting 60% win rates on TradingView. Watch your edge sharpen. Grab my free risk checklist below. Plug in your numbers. Start compounding while others chase ghosts. Think about it. Turtles beat hares every time. Slow, steady, unstoppable. Be the turtle. Your wealth fortress awaits.